Question 21. The exhibit below illustrates the share price and earnings per share for three companies, Tecra, Cosmos, and Lotley, in the technology sector for the most recent financial year, 2016. So we've got those metrics mentioned. Using the method of comparison, which of the following companies appears to be the most likely undervalued? Lotley, Tetra, or Cosmos? So to figure out undervalued, we're going to be using a multiple ratio. So in this instance, we're giving the price and then earnings per share. So we'll be using the PE ratio, which is price per share over earnings per share. So basically all we need to do is we're going to divide these two numbers. So for Tecra, 782.50 divided by 446.1. And that'll give us our PE ratio. And then we'll do that for Cosmos and Lotley. And the most undervalued is going to be the stock with the smallest ratio. So let's pull in what that looks like. So we'll be doing PE ratio. We get Tecra at 1.75, Cosmos at 1.24, and Lotley at 1.9528. So the most undervalued, so it's essentially what is going to be the smallest value, which is telling us the lowest price per amount of earnings, which is going to be 1.2446, Cosmos. Answer C. Question 22. Given the following information for a two-stock index for the year 2016, we've got stock A, beginning price, ending price, and dividends during the period, and then the same information for stock B. The price return of the index is closest to 30%, 35%, or 40%. So this is going to be pretty straightforward. We're going to take the price of each of these stocks and then divide that by the beginning price and then subtract out 1, and that's going to give us our price return. We're not going to need to include the dividend for either since we're just looking at the price. So our beginning price, that ending price then is going to be 13 plus 14 or 27. Then we're going to divide that by the beginning price for each of these, 10 and 10, which gives us 20 in the denominator, and we subtract out 1 at the end, gives us 0.35 or 35% price return. Answer B. Question 23. Adjusting the weights of the constituent securities in the index is known as rebalancing, readjustment, or reconstitution. So readjustment we can rule out right away. That's not really a commonly used term when referring to indexes and adjusting constituents or the weights of the constituents. So we can rule that out. And then looking at rebalancing or reconstitution. So reconstitution is going to be the time of the year, or maybe multiple times a year for some indexes, where securities are added or deleted from the index. So in this instance, we're not changing the constituents, we're just adjusting the weights of the constituents. So I'm inclined to rule out reconstitution. And then rebalancing is the answer that we're looking for here. When we're rebalancing, we're essentially trading the portfolio or the index back to the set weights of the index. So if you were doing a equal weighted index, for example, and you had 100 securities in the portfolio, each one should be at 1% weighting. Over time, those securities are going to fluctuate in value, and then you'd be rebalancing back to those original weights. So in that instance, we're not changing any of the constituent securities like you would be doing during reconstitution. You're just adjusting those weights as mentioned in the question. Answer A. Question 24. An equal weighted index is composed of two stocks. Stock A sells for $256 and has 25,400 shares outstanding. And stock B sells for $57 and has 232,000 shares outstanding. The equal weighted index value is closest to. So to calculate equal weighted index value, the shares outstanding is kind of a red herring in this instance. It's not needed for the calculation. All we needed to calculate is price, since we're going to be holding 50% of stock A and then 50% of stock B. So we just need to do 0.5 times each of these prices. which is going to give us this answer right here, which would be 156.5. Answer B. If we were doing market cap weighting index instead of equal weight, that's when the shares outstanding would become relevant, because that's going to change how the securities are weighted in the index. But for here, equal weighting, the shares don't matter. We're holding 50% of stock B and 50% of stock A, no matter what the share count is. Answer B. Question 25. Mark Bowie, a trader, buys stock on margin, posting 40% of the initial stock price of CAD 40 as equity. The price below which a margin call would occur, given that the maintenance margin requirement for the position is 25%, is closest to CAD 16, 32, or $40. So the formula here for this calculation is going to be margin call equals share price times 1 minus initial margin required. And that's going to be divided by 1 minus maintenance margin required. So our initial margin required is given at 40%. So 1 minus 0.4 is going to be our numerator. And then the maintenance requirement is 25%. So that's going to be our denominator. So that'll be 0.75. So we're going to be doing these two divided by each other. And we'll want to make sure we have that in our parentheses. And then we're going to multiply that by our share price of $40, which is going to give us $32. So we'll go with answer B. And again, what this number is telling us, this 32, is essentially we won't need to post any additional margin until the stock price goes down to $40. But once we hit that, or once it goes down to $32, sorry. But then once it hits that $32 threshold, we no longer have enough equity in our position, so we'll need to post additional funds or sell. Answer B. Question 26. Prime Bank intends to make an IPO later this year to mobilize funds in readiness for an ambitious expansion plan. If it opts for an underwritten offer, the risk that the general public may not take up the entire issue at the specified price will most likely be borne by A, the bank, B, an investment bank, or C, buyers of the part that will have sold successfully. So looking at these three answers here, the bank is referring to the company going public, and then the investment bank would be who's underwriting the offer. So that would be if opting for an underwritten offer. So looking at C, buyers of the part that will have sold successfully, this is going to be incorrect. The buyers that have bought into the IPO, they're not going to be responsible for the entire issue. They're only going to be responsible for the stock price of the shares that they've bought into. So we can rule that out right away. And then looking at the bank or an investment bank, being the underwriter, in an underwritten offering, essentially the investment bank or the underwriter agrees to buy any unsold shares. So it's up to them to basically get out there and aggressively sell the IPO and make sure that it's fully subscribed, so that they're not kind of stuck holding any unwanted shares. So in this underwriting scenario, the investment bank is basically guaranteeing a certain amount of capital for Prime Bank, and they bear the risk in this instance. Answer B. Question 27. Texas Corp is a calculator manufacturing firm expected to pay a dividend of $2 next year that will grow at 5% for 2 more years. If the stock is expected to sell for $30 at the end of the 3rd year and the required rate of return is 11%, then the present value of the stock is closest to, we've got $25, $27.05, or $31. So we're going to be using the cash flows function on our calculator to calculate this. So we will step in there at first. And so our cash flow 0 is not going to be input. And then for cash flow 1, we'll have $2 next year. So that'll be our first cash flow. So we'll hit 2, then enter. And then for cash flow 2, we're growing that dividend at 5%. So it's going to be 2 times 1.05. That's going to give us our second cash flow, which is 2.1. And then for our third cash flow, there's going to be 2 components here. So we're going to take that 2.1 and grow that by 5% again to get part of that third cash flow, so 2.205. And then we're going to add in the sale proceeds here. So we're selling for $30. So we've got 2.205 dividend plus $30 sale, which gives us 32.205. So we'll hit enter. So we've got our three cash flows in here now. So from here, we're going to calculate net present value. And we're going to do that using our required rate of return of 11%. So plug in 11 here, enter, and then we scroll down and we'll compute NPV, which is 27.0542, which once we round, that'll correspond right here with answer B. Question 28. Which of the following is most likely a commercial industry classification system that was jointly developed by Standard & Poor's and MSCI Barra? A. Russell Global Sectors, B. Industry Classification Benchmark, or C. Global Industry Classification Standard. So this is really just kind of a memorization exercise. So A, Russell Global Sectors, this is going to be incorrect. This was developed by the index provider, Russell, not S&P and MSCI. B, Industry Classification Benchmark, this one was developed by Dow Jones and FTSE, other index providers. And then C is going to be our correct answer since it was developed by these two. And this one's a little confusing too, because Russell and FTSE, who helped in both of these, are now one organization through merger. And then Dow, which helped with this benchmark, is part of S&P, which helped with GICS. So a little confusing, but mostly a memorization exercise here. Answer C. Question 29. Galaxy Ceramics is a ceramic and tiles manufacturing company based in Palo Alto. Some information regarding the stock is given below. So we've got required rate of return, return on equity, earnings per share, and dividend per share. Using the data given in the table, the growth rate of Galaxy is closest to 3, 6, or 7%. So to find the growth rate in this instance, we're going to have to kind of back into it based on what we're given in this table. So our growth rate is going to be equal to retention rate times ROE. And we're given ROE at 10% or 0.1, but we'll need to impute the retention rate based on dividend payout ratio or dividend and earnings, essentially. So retention is going to be 1 minus the dividend payout ratio, and our dividend payout ratio, pretty straightforward. It'll just be dividend per share divided by earnings per share, which is 0.3. So retention rate is going to be 1 minus 0.3 or 0.7. And so when we do the math there, it's going to be 0.1 times 1 minus 0.3, and then that's going to equal 0.07 or 7%. Answer C. And how this kind of works in theory is if we can earn a 10% return on equity, then in theory, any cash that we're not paying out as a dividend should be invested, can be or should be reinvested at this 10% rate. And so we're basically taking all the cash that we're not paying out as a dividend, so it'd be $3.50 per share, and that's getting reinvested at that 10% rate. But since the dividend is going to be taking away from that return, it kind of limits the growth rate. So the growth rate can't equal return on equity unless we were not paying out a dividend. So yeah, just a little extra color there on how and why that works. Answer C. Question 30. In which of the following methods do analysts adjust book values of the firm's assets and liabilities to their fair values? A, asset-based models, B, market multiple models, or C, discounted cash flow models? So starting at C here, discounted cash flow models, would we need to adjust book values of the firm's assets and liabilities to fair value to calculate this? And the answer is going to be no. And that's because discounted cash flow model is based on cash flows. So this is going to be a lot more income statement intensive. So the assets and liabilities are going to be less important for the valuation. It'll be important for return on assets, return on equity, return on invested capital, those types of numbers. However, for the discounted cash flow model, the key is cash flow and discounting those cash flows back to get the value of the firm. And then next, looking at B, market multiple models. Again, this is going to be similar to discounted cash flow models in that the multiple is typically going to be based on some type of number off the income statement, whether that's revenue, cash flow, earnings. The multiple model is going to be 5 times EBITDA, for example, or 1 times revenue. So it's not necessarily, again, based on assets and liabilities. It's based on the earnings and kind of operations of the company and how they make money. And then A, asset-based models. This is where it's going to be correct. In an asset-based model, you're essentially looking at what the value of the balance sheet is and then basing the value of the firm on that. So if the firm has $1 million of assets and $500,000 of liabilities, and that's the fair value of those assets and liabilities, then you could say the firm's worth $500,000. So we're going to go with A, asset-based model.